Good afternoon, ladies and gentlemen. Thank you for joining us for the results of Q1 FY20. Briefly, to touch upon the key highlights for the quarter. One, we continue to see good growth momentum in our advances and deposits. Both advances and deposits grew 35% year on year. Advances have now touched 56,837 crores and deposits 60,811 crores. CASA deposits grew 43% year on year to 15,706 crores. CASA percentage is up further to 25.8%. Within advances, wholesale advances grew 23% and non-wholesale grew 52%. So that journey continues to be very strong. I am pleased to report that our net interest margins have improved further. So we reached 4.31% this time, as opposed to 4.23% end of last quarter and 4.04% over last year. So over the year, it's been almost a 27 basis points growth in NIMs. Total revenue, net interest revenue and non-interest revenue all grew very coincidentally 48% year on year. All three, 48%. Our total revenue for the quarter was almost 1,300 crores, 1,299 crores. Net interest income out of that was 817 and non-interest income was 481 crores. Our core fee income, which excludes the trading income, etc., grew 42% year on year to 411 crores. In our credit cards business, we closed the quarter at 2 million cards. We continue to be among the top 5 in the country in new card additions and the retail spends per card. As a consequence of this healthy, very healthy net interest income growth and other income growth, we have reported a net profit of 267 crores for Q1, an increase of 41%. Our cost to income ratio was 52.3% for the quarter. On asset quality, today I would like to give some color on our corporate exposures in the light of some deterioration that we expect in the book over the next 2 or 3 quarters. As we build our corporate banking business, or as we built it over the last several years, we've taken a lot of care in completely avoiding lending to known troubled cases and several corporates with questionable credit profiles. However, challenges of the recent past, starting with leveraged positions of certain promoters, the tight credit availability and volatility in certain parts of the equity markets, shall impact the risk and credit liquidity profile, or is impacting the risk and liquidity profile of few of our clients. We expect this to play out over the rest of the financial year. With this background and based on a fairly detailed and thorough assessment of our exposures, our estimate is that we could incur additional 35 to 40 basis points of credit costs for the year, owing to the provisioning that will be required in some of the corporate names. Similarly, gross NPA levels could rise to between 2.25% to 2.5%, hopefully on the lower side, before they come down to more normalized levels thereafter. For the quarter, just concluded June 30th, our gross NPA was flat at 1.38%. Net NPA was down to 0.65% from 0.69 last quarter. We also took the opportunity to further improve PCR to 69.1% as of June 30th, as against 65.3% as of March 31st. Our return ratios also improved. ROA improved to 1.31 and ROA improved to 13.8% for the quarter. In terms of our network, distribution network, we added 8 bank branches and 20 BC branches in the quarter. We today have 332 branches, 1,013 BC branches. Out of it, 228 of them are now classified as banking outlets. So if you take these banking outlets plus direct branches, it's a number of 560 branches. Of the BC branches, RBL FinServ itself accounts for 458 branches. Our capital position continues to be comfortable, and our capital adequacy ratio is at 12.42% as at June 30th, 2019. Thank you very much.